So, before the break we were talking about the concept of duration and convexity, and I emphasize that duration is the linear approximation around the point of reference, around the YTM, where we want to explore the change in price, and convexity adds to it the factor due to the curvature of the yield price curve. There are other measures of price sensitivity, interest rate risk. We have talked about the DV01, the dollar value per basis point. We also have a concept called the modified duration. Modified duration is very similar to duration, except for the fact that it absorbs the factor 1 plus y 0 within the definition of duration itself. In other words, it is given by the Macaulay duration divided by 1 plus y 0. So, that in terms of modified duration we can write the percentage price change as minus d mod into dy. Then we have another important measure called the interest rate elasticity, or it is given by the ratio of the percentage change in price and the percentage change in YTM. Therefore, it is dp upon p 0, which is the percentage change in price, given by dy upon y 0, which is the percentage change in YTM around the point of reference. Simplifying this, we get it as p dash of y 0, because p dash of y 0 is what? P dash of y 0 is p dash of y 0 is dp upon dy. So, dp upon dy is captured by p dash of y 0. This p 0 is nothing but p of y 0 and multiplied by y 0, which is this y 0. So, this whole expression can be written as this, and this expression can be written in terms of duration as minus t upon 1 plus y 0. So, this whole expression becomes minus t y 0 upon 1 plus y 0, which is nothing but minus d mod into y 0. This is the concept of interest rate elasticity. I repeat, it is the percentage change in price divided by the percentage change in the YTM that relates to the given the percentage change in price that is being looked at. So, a recap, this slide gives you the recap of various quantities that we have defined. We have defined d mod in terms of d mac upon 1 plus y 0, dv01 is the negative slope of the price yield price curve, and we define the percentage change in price in terms of d mac and convexity using the Taylor series expansions, and the interest rate elasticity also we have defined in terms of d mac as d mac into y 0 upon 1 plus y 0, which is also equal to minus d mod into y 0. Now, we come to a very important concept. Let us say you have a portfolio consisting of bonds. Let us say you have a bond. Let us start with a single bond. You are invested in a bond, and at a certain point in time during your investment horizon there occurs a unanticipated change in interest rates. Now, when there is a change in interest rates, two factors come into play, two effects come into play. Let us say there is an increase in interest rates. Now, if there is an increase in interest rates, you will be able to reinvest the coupon payments that you receive at a higher rate, because the market interest rates have increased. So, you will be able to invest your coupon payments that you receive during the lifetime of your investment at a higher rate. So, that is a positive effect that you are going to get by your investment. Your coupon reinvestment income is going to increase because of the increase in interest rates. But when you assuming that your holding period or your investment period is less than the maturity of the bond, your holding period is less than the maturity of the bond, when you dispose of the bond in the market, what will happen to the price that you will get? You will get a lower price. Why? Because prices and interest rates are inversely related, and if there is an unanticipated increase in price, it will reflect in a unanticipated increase in interest rate, it will reflect in a downward slump in the price. And as a result of which the capital gains that you are expecting would be reduced, or you may incur a capital loss as well. Therefore, there are two opposing forces now coming into play. One is the reinvestment income is increasing, but the capital profits that you anticipated on the disposal of the bond are going to decline if there is an increase in interest rates. The inverse will happen if there is a decrease in interest rates. Now, obviously, these two factors, these two counter effects, let us say this is my T, that is my holding period, this is 0 and the maturity of the bond is capital N. So, obviously, these two factors, the reinvestment income and the capital loss will depend on your holding period, on this period. Why? Because larger the holding period, greater would be the benefit that you get because of the reinvestment process. Because if interest rates, let us say interest rates rise at t equal to 0, then you get reinvestment opportunities at a higher rate from 0 to t. And at the same time, if this is small, the negative impact is going to be less, because the number of cash flows that need to be discounted to arrive at the price at this point, to arrive at the price at the end of the holding period would be less, and therefore, the impact of the fall in interest rates would be less. Compare this, let us say, with a holding period of, let us say, this is T dash. Here the reinvestment income would be much less. However, the negative impact due to the discounting of future cash flows is going to be much more. In other words, what I am trying to say is that these two effects not only operate in opposite directions, but they are also related to your holding period, how long you propose to hold the instrument. There is a unique period between 0 and n, such that if you hold the instrument for that period, these two effects counterbalance each other. And if these two effects counterbalance each other, what is the impact for you? The impact for you is that if there is a change in interest rate, you get immunized, or your portfolio gets, or your bond gets immunized due to the effects of this particular change. Why? Because the positive effect of reinvestment would be annulled by the negative impact of capital loss, and vice versa. And this is the philosophy behind immunization. Let us now get, so to reiterate, there are two things. Any change, any unanticipated change in interest rates causes two opposing effects. One, a change in the reinvestment income, and an inverse change or opposite change in the capital gain. Number two, the two impacts are related to the holding period. These are two implications that you keep in mind, that we need to keep in mind in the sequel. Let us now go to the mathematics. We start with the standard equation P naught is equal to C t upon 1 plus y to the power t. C t are the cash flows over the life of the bond, and y is the YTM. Now, suppose you have a holding period of capital T. Let us say this is my holding period at capital T. Then let us look carefully how this operates. This is t equal to 0 say where the interest rates have changed. Now, I will get a coupon at C1, I will get a coupon C1 at t equal to 1. Let us say this is T1, I get a coupon at C1 at t equal to 1, a cash flow at t equal to 1. I can reinvest it for t minus 1 years. This is 0, so this is t years, this is t years, and this will be t minus 1 years. I can reinvest it at t minus 1 years at the prevailing rate, let us say it is y. Similarly, the coupon that I receive at t equal to 2, let us say C2, I can reinvest it for t minus 2 years, and so on, and the coupon that I receive at t minus 1 years will be reinvested for 1 year, and the coupon that I receive at t years will not be reinvested for 0 years. So, the total proceeds that I receive of this reinvestment, this reinvestment, this reinvestment, this reinvestment, and this will be equal to this expression, this summation C1 into 1 plus y to the power t minus 1 C2 1. So, this is the reinvestment part. This summation covers the reinvestment part. Now, at t equal to 0, at t equal to capital T, I am sorry, at t equal to capital T, when I liquidate this investment, let us say the price that I get is P capital T, P capital T. Now, what will be P capital T? P capital T will be equal to, now let us look at it here, T, this is N. P capital T will be equal to the present value of all future cash flows that I am going to receive from T to N discounted at the rate Y. So, the cash flow that I am going to receive at T plus 1 will be discounted for 1 year. The cash flow that I am going to receive at T plus 2 will be discounted for 2 years, and so on. The cash flow that I receive at T equal to capital N will be discounted for N minus T years. So, the summation, the price will be equal to the summation of these discounted values, which is given by this expression. T plus 1, the cash flow that I get at T plus 1 discounted for 1 year, the cash flow that I get at T plus 2 discounted for 2 years, and so on up to capital N, that is N minus T coupons will, or N minus T cash flows will be discounted. If I change the summation index from j equal to 1 to N minus T, I want to use N here. So, what I do is T plus 1 to N, that is what I do, and instead of T plus j, I will use this expression is now k, this is now k, and j now becomes k minus t, and this becomes this expression. Similarly, simply replacing k by small t. So, therefore, the total cash flows that I get for a holding period of capital T are the summation of this summation plus the summation that was there on the previous slide, that is this summation. Let us call this summation A and let us call this summation B. If you add A and B, then this, you see, A is the summation extending from 1 to capital T, and this is the summation of the same quantity extending from T plus 1 to capital N. So, the two, when the two summations are taken together, A plus B, my summation index will run from 1 to capital N, and this will remain the same because it is the same in both cases. Now, let us take the derivative of this with respect to y. What do I get? I get this expression. If I differentiate that with respect to y, this will become 1 plus y to the power n will be say x to the power n. X to the power n is derivative is n x to the power n minus 1. That is what I have used here. Now, if you look at this, if I equate this to 0, then leaving this as it is, let us look at this. 1 plus y to the power t minus small t minus 1. Now, capital T minus 1 plus y to the power capital T minus 1 can be taken common outside this. It has nothing to do with the summation. 1 plus y to the power capital T minus 1 can be taken outside the summation. It has nothing to do with the summation, and therefore, if the whole expression is to be 0 and this 1 plus y to the power t minus 1 is certainly not going to be 0, the rest of it must be 0. And when this is simplified, in other words, this goes and we are left with t minus small t c t 1 plus y to the power minus t is equal to 0. When you simplify this, we get capital T is equal to this expression. But this denominator, if you look at it, if y is to be the YTM, then the denominator becomes P0 and this whole expression becomes T, which is the duration. You can compare it with the earlier expression for duration, and you will see that this expression turns out to be the duration. So, in other words, what have we said? Let us recap it. The total cash flow is this expression. The derivative of the total cash flow, if it is equated to 0, now derivative 0 means the derivative of the total cash flow with respect to y is 0 means what? It means that the total cash flow is independent of y at this point. The total cash flow is independent of y at this point. What is that point? That point is given by when T capital T is equal to the duration. In other words, so what is the outcome of this? The outcome of this is that if I am holding a bond, I am invested in a bond, and I plan my investment horizon in such a way that my investment horizon equals the duration of the bond, then I get immunized against any fluctuation in market interest rates. So, that is the outcome of this analysis. Now, let us look at what are the assumptions or what are the caveats, what do we have to be careful about while implementing this philosophy. That is very interesting. The first thing is, remember, we have used Newtonian differentiation. Newtonian differentiation assumes that around that point of reference, where you see where we are differentiating at y. Therefore, around this, in small interval around this, y plus dy and y minus dy, we assume that our yield price curve is a straight line. You see, what are we trying to say? We are trying to say that d of TCF upon dy is equal to 0. Now, this is nothing but the slope of the tangent of TCF with respect to y. When we talk about slope of the tangent, we are talking about two very closely spaced points, the straight line joining two very closely spaced points. In other words, what we are simply saying is that around this point y, if we take a very close point, say y dash, then we assume that y dash line or the yield curve between y and y dash is a straight line. That is an assumption. So, the implication is, and because no, let us look at the practical implication. The practical implication is because the yield price curve is curved, therefore, in order that we are able to approximate it by a straight line, we must have the y and y plus dy very close to each other. Only then we can approximate this curve by a straight line. What does it give us? It gives us that this immunity that we are talking about, the protection of total cash flows against a change in interest rates that we are talking about, holds for very small changes in interest rates. In other words, if you say change in interest rate from say 5% to 8% or 9%, that immunity is not going to be there. The portfolio value is going to change even if you hold it for the duration. But for a small change in interest rates, very small changes in interest rates, this immunity will hold, as I will illustrate by an example to follow. So, this is very important, because the yield price curve is curved, the assumption of a straight line will hold for a very small interval, and the immunity also holds for a very small interval. And of course, there is an implied assumption that y captures the entire term structure and y is constant for all maturities. In other words, all cash flows that are arising from the instrument are discounted or are compounded at the same rate. This is a further mathematical analysis of this. Here I have tried to show is that the second derivative of total cash flows with respect to y turns out to be positive, and that shows that this cash flow at this point is also a minimum. I will, instead of going through this, I will give an example. Let us look at this, it is very interesting. I have considered a 12% bond, coupon rate is 12%, maturity is 25 years, YTM is 16.65%, the duration works out to exactly 7 years. At a YTM of 16.65%, the duration works out to exactly 7 years. Therefore, I have fixed the holding period at 7 years, so that I hold the bond for 7 years. I have then worked out the total cash flows, that is the cash flows of reinvestment and the price at which it would be sellable at the end of the 7th year as per the present value formula. What are the outcomes? If the reinvestment rate, if the market rate turns out to be 11%, my total cash flows turn out to be 2251, 12% 2210, and so on. The interesting figures are here. At a reinvestment rate of 16% or a market rate of 16%, the cash flow is 2137, and at 16.65% is 2135.63. Again, when you increase it to 17%, it becomes 2135.94. 41, and here you have 1 unit of money. That is one important feature. If I plot the total cash flow against y, I get a flat region. This is very clear here. The second thing is, at the YTM corresponding to the duration 7 years and the YTM of 16.65%, the total cash flow is the minimum. As you can see, it increases here and it increases here. Therefore, if you plot total cash flow against the YTM, you are likely to get something like this, and this region is relatively flat. So, that is the relevance of duration. That is the very important concept of duration, that it reduces your risk. If you plan a holding period of your bond portfolio in such a way that it is close to the duration of the bond, then you are significantly protected against interest rate risks subject to small changes in interest rates. Now, a small because we shall be using this in the sequel, duration, when we have so far talked about annual compounding. Now, we talk about a situation where we have continuous compounding. In the case of continuous compounding, the formula for the price becomes the present value of future cash flow, that is as usual, but the expression changes CT into the present value interest factor, which in terms of continuous compounding becomes this expression. So, when you simplify this and you use this expression for the duration, you find that Py is equal to minus d, this is the duration, into dy. In other words, that factor 1 plus y0. In the case of annual compounding, if you recall, Py upon dPy upon Py was given by minus d into dy upon 1 plus y. This factor is no longer there when we talk about continuous compounding. So, we shall be using this when we talk about interest rate futures. That is why the concept is presented here. This is an alternative definition. Those of you who are interested can have a look at this. Now, some interesting properties. Duration of a zero coupon bond is equal to its maturity, because there is only one cash flow. Therefore, it is quite simple to compute the duration of zero coupon bond. It turns out to be equal to its maturity. Therefore, long term zeros are obviously more sensitive to than short term zeros. This is the duration of a level coupon bond. This is a mathematical derivation of the duration of a level coupon bond. And a fallout of this is that for a perpetuity, this expression would be 0 and Pc would be equal to P. Therefore, for a perpetuity, the duration would becomes 1 plus 1 upon y, and this becomes independent of the coupon rates. So, duration for a perpetuity does not depend on coupon rates. The duration of a 0 equals the maturity, and bonds with higher durations have higher price sensitivity than bonds that have lower duration. Now, there are certain properties of duration which are quite useful. As far as coupon rates are concerned, duration and coupon rates are concerned, if you increase the coupon rates, then duration is going to decrease. The higher the coupon rates, other things remaining the same, higher the coupon rates, other things remaining the same will decrease the duration, because the cash flow is being more rapidly recovered from the instrument by the investor, and therefore, the duration decreases and the interest sensitivity also decreases. As you can see in this empirical work, as the coupon rate increases, the Michaelis duration shows a clear cut decrease throughout. So, as coupon rate increases, the recoupment of the investment is faster, and therefore, the duration is less, and the sensitivity to interest rates is also reduced. Duration and maturity for par and premium bonds, duration increases with maturity, there is no dispute about that. But as far as discount bonds are concerned, duration shows a slightly anomalous behavior. Up to a critical value of maturity, duration increases, and then it starts to decrease until it reaches the perpetuity value. You can look at it in this figure. As the maturity increases, look at this figure, from 4.3 it goes to 5.06, and then it starts declining, and gradually it tapers on down towards 5.00, which is the duration of a perpetuity. Okay. Now, a brief touch on the price sensitivity and maturity. The price sensitivity of a bond, if you measure it by dV01, is given by dP upon dy, and if you recall the definition of the modified duration, then it is given by modified duration into price. In other words, what I am trying to say is that dV01, which is equal to minus of dP upon dy, is equal to d mod into p. Therefore, dV01 is behaves as a conjunction of two factors, two quantities. One is the duration and the second is the price. In other words, two effects, the duration effect and the price effect, are encapsulated in dV01. Now, in the case of par and premium bonds, as maturity increases, duration increases. And we also know that in the case of premium bonds, as maturity increases, the price of the bond increases, and in the case of par bonds, the price remains constant. So, the net effect of these two things is that as far as par and premium bonds are concerned, both the effects operate in the same direction, and therefore, dV01 increases as maturity increases. The duration effect also increases because duration increases, and the price effect also increases because price increases as maturity is increased. However, in the case of discount bonds, the behavior is slightly different. The behavior involves two things, as I mentioned earlier. One is the price effect and the other is the duration effect. We talked about duration, that the duration initially increases and then it tends to decrease. The price of a discount bond decreases as maturity increases. So, here we have two conflicting effects for some period of time in the initial stage, when the duration effect increases and the price effect decreases. Therefore, there could be some anomalous behavior. If duration effect predominates, then the price dV01 would increase, and then gradually dV01 will start decreasing. A quick issue about maturity and bond price sensitivity. Maturity and bond price sensitivity, as you can see from these two examples that are here, you can see if you have got two bonds X and bond Y. Bond X has a maturity of 2 years, bond Y has a maturity of 10 years, and if you look at that, the sensitivity of bond Y is far more than the sensitivity of bond X in terms of absolute value. This is more than this in terms of absolute value, showing that as maturity increases, the price volatility or price sensitivity of a bond also increases. And one more thing, as per this is also shown in the diagram, this is a short maturity bond which has a less steepness, and the long maturity bond has a far greater steepness. And as far as coupon size is concerned, as the coupon size increases, you can see if you have two bonds with different coupon sizes, one with 10%, one with 80% coupon size, you can see that the 10% has a higher absolute sensitivity compared to the 80% coupon. This is because the the cash flows or the recoupment of principal and cash flows would be earlier in the case of bond Y in the higher coupons bond compared to the lower coupon bond. As a result of which the lower coupon bond would be more sensitive to interest rate changes than the higher coupon bond. Thank you.